Welcome back to the channel. Sorry I've been a piece of shit lately. I've actually had to work for a living this week. But in this market this week, down 2.5% today and almost 6% down this week. So Federal Reserve came out and hiked their rates by 75 basis points, putting it at 2008 highs. So, not that we didn't expect that. The market's really getting a little concerned with the fact that inflation still came out higher than it was expected. Rates are going higher. They said that they're going to do another 75 basis point hike next meeting and possibly a 50 the next, which if we can see that inflection of them getting a tad bit dovish, although it's still a hike, we could see the markets rebound probably the beginning of next year, hopefully. But right now, markets are trending generally around where they were January, February of 2021, which in my opinion is kind of a deal. But if we, zoom out, it's really, we're not doing that bad. I'll say we'll probably be doing bad when we start hitting our February 2020 levels and start retracing. But if you look at these trend lines here, very rarely do we break this trend. You know, we did back in 2018, COVID, and this weird market that we had back in 2015. So be skeptical around here if we don't get any support and we just do some more free falling, maybe a relief rally. That'd be nice. So looking at Bitcoin, we have, once again, falling out of this rising wedge and just generally going sideways. We have not set a lower low because the low is generally around 17,700. Not horrible. Once again, still a buying opportunity. Plan B if you're not familiar with him, but some Bitcoin at this level, still basing his stuff off the stock to flow model. So going to CNBC, Dow tumbles nearly 600 points into a bear market territory, sets a new low for the year. So, best thing to do in these markets is don't sell, just buy more, dollar cost average into this cheap stock. The bond yield soared this week following the Fed's action at the 2-year. The 2-year and the 10-year Treasury rates hitting highs not seen in over a decade. So if we look at the 10-year Treasury here, we haven't seen rates like this since, it's hard to think a decade was 2011, or 2011 right here where we're at 3.68%. Other than that, I have not seen too much going on in the yield curve. So it's a slightly inflected, but not, enough to really point out a recession, although technically in a textbook setting we are in a recession. So other than that, inflation, higher rates are a dangerous mix for consumers already stretched thin, says Chief Financial Advisor. So this is a kicker, not to say that we're going to head into any of those subprime mortgage issues, but anybody who had refinanced to an adjustable rate mortgage are going to be paying a lot more than what they have been doing, because they may have thought that rates were going to go down. Rates in fact went up. So if they were stretched thin on a adjustable rate mortgage at 2.5%, now they're going to be hitting a 5 to 6% interest rate, which could definitely raise their rates. Also with credit card debt, if you don't have a fixed rate loan on anything, say through like SoFi, not shout out for SoFi, I'm not sponsored or anything, but hit me up. SoFi, gives fixed rate interest loans for 5 years, 5, 6, 7 years, however you need it, which is kind of nice for debt consolidation, especially in higher interest rates. So let's hit up some Wall Street bets, and this sums it up pretty well. The Federal Reserve. I can raise and lower rates at will. Why would you raise rates? So I can lower them. Which is generally what it is. Once they start lowering, the market will literally probably do a V-shaped recovery like this. This is tech stock, so Usually you see more of an inflection with this, uh, in tech stocks. So risk on investments when interest rates go up, you know, it goes down. So we're down almost 70% on TECL, which is probably one of my favorite. It's a 3x tech stock, which is, risky, but I mean, if you buy it at the bottom here at the COVID crash all the way up, that's a 10x return, which is beautiful. It did have a split, so it was generally around what it is now, but even right here, I mean, adding some of this TECL to a portfolio definitely wouldn't be bad. Also, just looking at the DXY, we are hitting some higher highs. We haven't seen the DXY this high since 2002, which is insane. So this was generally the dot-com bubble. So it's getting a little sketchy here, not gonna lie. So all in all, I did make an investment today in GOF, $15.36. This is probably a bigger crash that it has seen. I shouldn't say crash, but a biggest adjustment seen in a while. So this puts their dividend payout at 14.23%, and that is 18.2 cents per share. And they've been pretty consistent on that. Check my video about that, that posted previously down below. And yeah, make sure you hit that like and subscribe button. I'll be better next time. I'll post more shorts. I just busy week at work. So thank you. Hit that like and subscribe button, and until next time.